And then Wednesday brought the day we've all been waiting for, Fed Day. Early in the morning, bonds were broadly sideways overnight with gains heading into the European session. Then steadily weakness as progressed, and the net effect was just slightly weaker at the open of domestic trading. Then we got export prices. Export prices were down 0.3% on a 0.4 forecast. It was 0.4 previously. Import prices were down 0.6% on a 0.5 forecast. After that, MBS were down 14 basis points early on the open. Then we got the Federal Reserve statement. The broad takeaways are the Fed downshifted to a 50 basis point hike, which they telegraphed in advance following 4 consecutive 75 basis point increases. The unanimous decision brought the target range to 4.25% to 4.5%, which is the highest since 2007. Things were great back then. Everything else released at 2 p.m. The mean forecast for rates at the end of 2023 was 5.1%, higher than investor expectations and from 4.6% the prior round in September. Most officials did foresee rate cuts in 2024, with the median rate forecast 4.1%, slightly higher than it was in September. The distribution of forecast for 2020 was on the higher side, with 7 officials above 5.1, 10 at 5.1, and 2 at 4.9. So we're not done hiking. The unemployment rate is seen to be rising to 4.6% at the end of 2023 and holding there in 2024 compared to the current of 3.7%. Anything below 5 is still seen as being very good. Key growth is seen at 0.5% in 2023, down from 1.2% in September. The GDP now out of the Atlanta Fed has been all over the place, so who knows on that one. The FOMC statement retained language saying ongoing hikes will be appropriate to reach sufficiently restrictive stance that returns inflation to 2% over time. So we're not done here, folks. That's a long story short. So at the end of the day, we're up 13 basis points on the MBS and down 3 basis points on the U.S. Treasury below the 3.5 threshold. At the end of it, we are at 101.44, which puts us just under that ceiling at 101.671, and then we're holding a pretty strong floor right there, that 100-day moving average. That 100-day moving average has been holding up really well, but it's also reinforced at that 100.758 Fibonacci line. So that tends to hold things pretty good, but it is a very narrow range. We also got news today that Chase apparently raised its net worth requirements for correspondents from $2.5 million to $10 million net worth, which is quite interesting because, I mean, I'm sure their volume is down just like everybody else's, but they're making it more restrictive. So that kind of tells you about what Chase thinks about the potential fates of mortgage companies in the coming year.